Trump is waging an illegal tariff war, and it doesn't end with this deal. It undermines rules-based trade and raises tough questions about Europe's strategic autonomy, with very little clarity on how stable or lasting this agreement will be. That warning from the Socialists and Democrats group in the European Parliament captured perfectly the fragility built into the US-EU trade deal announced on July 27, 2025. Branded as a breakthrough for the world's most important economic relationship, one that moved over 1.6 trillion euros in goods and services in 2024, the deal promised stability. On paper, the terms looked attractive. The United States would cap tariffs on EU goods at 15%. In return, the European Union pledged massive procurement and investment, including $750 billion in energy, $40 billion in AI chips, and $600 billion in new investments into the American economy. But almost as soon as the ink dried, the cracks began to show. Instead of delivering stability, the deal revealed a foundation built on promises that couldn't be kept, met with fierce political resistance inside Europe, and ultimately left the US and ordinary Americans with a toxic legacy of higher costs and deeper uncertainty. So the real question is, how could a deal of such magnitude unravel so quickly? To understand why the deal collapsed, we first need to ask why it was made in the first place, The structure of the US-EU trade agreement, at least on paper, was designed to rebalance a strained relationship. Washington offered a clear concession by setting a fixed tariff ceiling. According to White House documents, the United States committed to applying whichever was higher, the US most favored nation, MFN, tariff rate, or a flat 15%, including MFN and reciprocal tariffs, on goods originating from the European Union. The idea was to replace a messy, unpredictable tariff system with a single cap, giving European exporters clarity. In return, the EU's commitments looked almost overly generous, promising a massive surge of demand and investment into the US economy. The European Commission laid out the details. The EU intends to purchase US liquefied natural gas, petroleum, and nuclear energy, worth an estimated $750 billion, around 700 billion euros over the next 3 years. The EU also plans to buy 40 billion euros worth of AI chips. And European companies have signaled interest in investing at least $600 billion, around 550 billion euros, across various US sectors by 2029. But these very commitments were the first and deepest cracks in the foundation of the deal. The problem wasn't intent. It was feasibility. From the start, observers quickly flagged several promises as either implausible or outright impossible. The biggest and most obvious issue: legally, the European Commission has no authority to force European companies to buy American products or invest in the US. And even if the Commission somehow found a way to pressure businesses to reorient toward America, the numbers themselves looked absurd. Break down the math and the unreality jumps out. The EU's $750 billion energy pledge over 3 years works out to $250 billion a year. That's not just triple what the EU spent on US energy in 2024, it's far beyond America's entire export capacity. The US exported only $166 billion worth of energy products in 2024, and production in 2025 is expected to decline as global oil prices remain too low for American shale producers to turn a profit. For the United States, this meant the deal rested on a promise of economic windfall that the other side simply couldn't deliver. Energy, tech, and finance industries were told to expect massive new revenue streams and investment capital, but none of it was backed by binding mechanisms or grounded in market reality. At its core, this was a political deal dressed up as an economic one, driven by Europe's desire to avoid a full-scale trade war and secure continued US backing for Ukraine. In private conversations, Ursula von der Leyen's allies admitted they needed a deal with Trump to keep him on Ukraine's side. Her defenders argued that a lopsided trade agreement was the price required to keep America's notoriously unpredictable president aligned with Kyiv. The result was an unbalanced deal at its very core. Washington walked away with grand promises that could never be delivered in exchange for a slightly more predictable tariff structure. That imbalance planted the seeds of collapse because it created an agreement European stakeholders could neither accept nor enforce, leaving U.S. businesses and consumers in a precarious position. Almost immediately after its announcement, the deal was met with fierce backlash inside the European Union. Commentators and political leaders quickly recognized its one-sided nature, describing it as capitulation rather than negotiation. When European Commission President Ursula von der Leyen unveiled the new US-EU trade agreement, controversy erupted. Commentators and several European leaders mocked it as an act of surrender, warning that it wasn't just unbalanced, but also risked undermining Europe's reputation as a defender of the rules-based order. This opposition wasn't just talk, it quickly turned into concrete political action. Senior officials began voicing their reservations in public, and major political blocs in the European Parliament announced their intention to block key parts of the deal. AP News captured the skepticism at the very top of Europe's legislature. The chair of the European Parliament's Trade Committee said Wednesday that he had doubts about aspects of the EU's trade deal with the Trump administration and predicted the deal could be amended during the legislative approval process. Both myself and some of my colleagues have doubts about this deal. The backlash was reinforced by a fundamental legal issue. The agreement appeared to violate the World Trade Organization's core rules. By unilaterally granting tariff-free access to U.S. industrial goods, the EU was undermining the most favored nation (MFN) principle, which requires equal treatment for all trade partners. Euro News analysis was blunt. At first glance, the August 21st deal was a serious breach of WTO rules. The U.S. president unilaterally demanded preferential tariffs for American imports into the EU, violating the MFN principle. From the perspective of WTO rules, the deal is discriminatory. The mix of economic impracticality, political imbalance, and legal fragility created a perfect storm. EU leaders, who may initially have hoped to appease Washington, now faced mounting internal pressure. Senior officials began openly drawing red lines. The first signs came last week when the EU's Industry Strategy Commissioner suggested reconsidering the deal, and Teresa Ribera, Executive Vice President of the European Commission, told the Financial Times that the EU should be prepared to walk away if Trump continued to push changes to Europe's digital regulations. The backlash reached its peak when leaders publicly admitted that security concerns had been the driving force behind the agreement and reaffirmed EU sovereignty. Their message was clear: America and all partners must understand that Europe will always defend its independence. For the United States, the consequences of this pushback were immediate. The core benefits promised by the deal, especially the EU's elimination of tariffs on U.S. industrial goods, required approval from the European Parliament. With opposition mounting, that approval was anything but certain. American exporters of cars, machinery, and farm products, who had been promised a wide-open market, now faced the prospect of the deal collapsing before it could ever take effect. That same day, the Socialists and Democrats group in the Parliament issued a blunt statement. They would not vote for the deal once it reached the chamber. To put this in perspective, the Commission needs parliamentary approval in order to cut tariffs. This made one thing clear. While the EU is actively working to diversify and strengthen its rules-based trade relationships with other partners, like Mercosur, its relationship with the US is being eroded by a deal seen as imposed, one-sided, and unsustainable. In fact, diversification away from overdependence on China, and especially on the United States, has now become the central strategy. The collapse of the US-EU trade deal was not just a diplomatic failure, it carried real negative economic consequences for the United States. The single biggest promised benefit for American businesses, duty-free access to the EU market, was now suspended in limbo. Meanwhile, America's side of the bargain, a flat 15% tariff on European goods, remained in place, creating a worst-case scenario for both US consumers and certain industries. While the 15% ceiling was considered an improvement over Trump's earlier threat of 30% tariffs, it was still a heavy tax on trade. One EU official openly admitted the point. The tariff wasn't prohibitive, but it was painful. As Sabine Weyand, Director General of the EU's Trade Division, told Parliament in a hearing reported by CNA, "There is a level where a tariff becomes prohibitive and trade stops flowing. With a 15% across-the-board tariff, that is not where we are, but it is still significant. Yet the fact that trade still flows doesn't mean it comes without cost. That 15% tariff, labeled by the S&D Group as an irrational and illegal tax, ultimately lands on American consumers in the form of higher prices for European goods, from German cars to French luxury products. At the same time, U.S. businesses that rely on European machinery or components now face higher input costs, cutting into their competitiveness. Uncertainty is another consequence. The deal was not a legally binding treaty, but rather a political agreement sketched out in joint statements. As the law firm Covington and Burling noted, while the July 27th deal eased an immediate tariff spiral, the absence of a binding legal text left room for conflicting interpretations, further negotiations, and endless opportunities for stakeholders to lobby U.S. and EU officials as the details were still being fleshed out. That ambiguity meant American businesses could not plan long-term. Automakers promised tariff relief still faced uncertainty over future trade rules. Agricultural exporters promised preferential market access had no clarity on when, or even if, those benefits would ever materialize. More importantly, the collapse of the deal exposed Washington's failure to secure meaningful concessions from Europe. And in a sense, the fact that these promises were impossible to deliver wasn't necessarily a downside for Ursula von der Leyen. It implied she had played Trump by offering commitments that would never come to pass. The United States, meanwhile, gave up real negotiating leverage in exchange for empty pledges. That not only weakened America's economic position, it damaged its credibility at the bargaining table worldwide. Other trade partners will look at this collapse and conclude that U.S. commitments may be unreliable or based on flawed assumptions. In the end, the collapse of the deal leaves the United States with a legacy of higher costs and deeper instability. American consumers are paying more for imported goods. U.S. businesses are navigating a trade environment more unpredictable than ever. And the country is left confronting the reality that a deal once touted as a major victory unraveled almost instantly, raising hard questions about America's trade strategy and its position in a shifting global economic order. This failure underscores a harsh truth: trade agreements built on political pressure rather than sustainable economic principles rarely deliver lasting prosperity.